Q1 performance and attribution. Overall, it was a positive quarter for the IMFs as all our strategies were in positive territory over the last 3 months. Our returns ranged anywhere from 2.66% for our conservative offshore model portfolio to 4.65% for both the aggressive offshore and domestic strategies. We benefited from not de-risking our equity positions below neutral, and that allowed us to participate in the overall positive performance of global stocks throughout the quarter, despite the rough patch due to the banking crisis that first started among non-sci-fi U.S. banks. Regionally, our European equity investments performed the best, outperforming global equities by 3.7% to 9.4%. On a style basis, our U.S. growth factor investments outpaced the same index by 7 to 7.6%. On the flip side, our high dividend equity positions lagged their peers, and our U.S. small and mid-cap equity positions underperformed their benchmarks, hurt by their exposure to financials. With respect to rates and credit, increasing these assets up to neutral from underweight in the previous quarter contributed to positive performance by helping to cushion the effects of the bank-led drawdown. Most of our fixed income positions performed expectedly well, with the exception of our investments in preferred shares. Unfortunately, the financial sector dominates the preferred share asset class, and the aggregate underperformance of banks and financials hurt us. As you will hear shortly, we did not trim our positions since we do not think that the current banking troubles will morph into a systemic crisis of the financial system. In fact, we will be net buyers during the rebalancing. On the alternative side, our investments in gold were up over 8% for the quarter, as we have direct exposure to the precious metal allocated among several strategies. However, the broad commodity complex was pulled down 4% quarter to date, driven by negative price action in energy and the industrial metals. We will take this fall in prices as an opportunity to rebalance higher, as our thesis that we are in a structural bull market in commodities is intact, and we continue to like them as hedges to geopolitical risk, which remain elevated. Finally, our real estate holdings also helped to offset some of the weakness in our alternative bucket, as the real estate sector benefited from expectations of the imminent end of the Fed's tightening cycle. Insignia Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Public Advisor Public Disclosures website, https://advisorinfo.sec.gov/.